Okay, ladies and gentlemen, we are starting a webinar, and it's titled the Measured Move Diagram webinar. It is a combination of slides that were put together by Random Pattern, who is known here as a member for a long time, an incredible mind, and someone that had helped me create some of the illustrations for my book. He has a program here that he has taken and helped me create slides that will put a little bit more better perspective on, or a little bit clearer structure on somebody that was just getting started, view these patterns inside of the market. And what I want to point out first here is that these patterns that we're going to be talking about aren't something that is new inside of our markets. You can go back to 1929 and these rules apply. You know, the high, how, and that exists, you know, from 50s to targets, and, you know, markets coming halfway back. I believe that these patterns exist in the market. They're fractional. They're part of nature. You find them in flowers and pine cones and in anything that's alive. It's geometry, it's nature. And it is really a fascinating subject. But the first thing I want to point out here is that it's not dependent on algorithms. These markets have adhered to these patterns as far back as we have data to view it. So that's the first thing, you know, that I want to point out. The second thing is when we go into these, the idea that the market has repeatable patterns is sometimes hard to see unless you have some structure to base it on. And there are three types of measured moves, and we consider these predictive models of price behavior. They exist on all time frames. There's no such thing as a wrong time frame. Time is something that we invented. It's not something that, you know, the markets adhere to. For the three types of setups are the basic move, or what some have heard here called a traditional measured move. That traditional measured move, a traditional measured move is where a market retracement is drawn from a high to a low or from a low to a high. The most recent low starts the draw with a Fibonacci retracement, and it's drawn to a most recent high. It isn't a measured move long, or a basic move, unless the market makes a pullback into a 50% retracement. Okay? This is what's called a traditional measured move, and it retraces. One of two things happen when we hit a 50% long like this, in this case, a long setup. There's a test of the support level, which is a 50% retracement, or there's a failure of its 61.8% line, and that's the stop loss and the exit. If it isn't stopped out, it has the potential of rallying to its target, which is 123.6%. So that's what a traditional measured move is. Now, what's an extended move? An extension or an extended move here is when the markets blow past a profit target. It's a retracement from the high to high of a long setup that has gone through its target, or from a low to low from the same side of the swing. You're drawing from the high before the breakout to highs, or the low before the breakout to lows. And there are a couple, you know, equivalent terms that you might be familiar with. A traditional measured move is a basic move, is what some might call a mean reversion, what we call a 50% retracement or a halfway back. That's all the same thing. An extension is an extended move. It's a momentum reversion type trade. The 50%, it's called a 50% retracement from the same side. It's drawn from the same high to high. A new extension is established when a market has hit its profit target and then goes through it again and uses the same anchor to high. So that's an expanded extended move. We call it a new extension or expanded extension. So these are just some terms to get familiar with before we move on here to some of our other slides. Here's a breakdown of how a measured move, or a breakdown into two parts. And we have an example of a long here, and we have an example of a short here. First is the setup. The setup inside of a long setup is drawn from a low to a most recent high. It trades its halfway back entry. This is the setup. This is the setup portion of the measured move, the basic measured move. The completion happens when one of two things happen. It's either doesn't respect its 50 and stops out at its 61.8% line, or it bounces from its 50 and completes its profit target. The profit target is the exit. We have the highest probability and lowest risk entry at that 50% retracement with the 61.8% line as a stop. So there is a traditional example. Here is a traditional short, or a basic measured move short. Its retracement is from lows to highs, or in this case, from highs to lows. Its 50% retracement is an entry into that trend. That's the setup. The completion of it is when we either do one of two things. It either is stopped out, or it moves away from its 50 and completes its profit target. This 50% retracement with a stop above the 61.8% line is our highest probability, lowest risk entry. So that is how a traditional measured move is set up. Now, when we go into an uptrend and a new high is being hit at a profit target, the profit target, or where the market reverses from that target, can only be known in hindsight. The high should not be guessed at. We can't short profit targets, right? We can take profit at targets, but we can't short profit. We can't short blindly or naked short profit targets. The high shouldn't be guessed at with a hunch that price can't go any higher. Entering a trade on a hunch won't give you an edge. It's hit and miss, and the results will be ultimate failure. So in an uptrend, the new low is anticipated to be the 50% retracement with support from the uptrend traders behind the move. It's important here to understand the kind of structure that goes behind a traditional setup and who's buying and who's selling. In this example here, and what we're talking about is this is a swing high. What you're viewing here is the setup. We're drawing a pullback from a lows to a swing high, anticipating a halfway back. But it's important to understand what is going on inside of this from the perspective of the psychological move and also what's going on with the orders. So at this exact moment when we're about to pull back into a long setup, who is selling? Who is selling? The right-away traders. Those are the ones that have profit. They're longs with profit. This is a target of another previous long, right? It was the profit target of another previous long. So longs with profit, and they're sellers to close, exiting with a confirmation of their entry. Trend traders trading with the longer term trend as well. Who else is selling at this high? New shorts, and shorts adding. They're selling to open a position. They're entering it in anticipation of a price drop, and they're also counter trend scalpers, anticipating a pullback down into the support level. So inside of this halfway back long, so who is buying up here? And let's talk about them too, because there's two sides to every trade. At the top of this move where the profit target has been hit, in reality, everyone knows about the tick chart. When the tick is at its all-time high, we know that we can't buy high ticks. Who is buying at the top of this move at a profit target, at a previous swing high? They're squeeze shorts. They're reactionary buyers. They're buying to close, BTC. They're forced exit. They're being forced to exit with a loss. They maybe were shorting low ticks. Now they're having to cover. Who else is buying up here? They're the wrong way traders. They're the new longs. They're trying to chase a moving average crossover, or they're chasing a rally inside of a high tick. They're buying to open new positions. They're entering in anticipation of a rise in price. But the market ultimately pulls back. So what do we anticipate when the market pulls back into those support levels, into the halfway back? Who are the market participants inside of the traditional or basic measured move? As price rises at the trend test, as order flow shifts to buying, supply falls as those wrong way traders hand off to the right away traders. So who is buying inside of that pullback? There are new longs and longs adding. They're buying to open new positions. They're entering in anticipation of a rise in price. Trend traders trading with the trend are also adding to positions. Who is also a buyer or a force, who is also taking profit inside of that pullback. The same shorts up here that were adding to positions, potentially creating a counter trend scalp from the highs back into the pullback. They're taking profit. They're buying back their shorts for profit. They're buying to close their short position. They're exiting with a confirmation of their entry. They're counter trend scalpers. So who is selling inside of this pullback? We call them the wrong way traders, the ones that they're selling the low ticks, right? Right at the bottom of move. They're chasing a moving average sell crossover. They're liquidating their longs. They're forced to exit with a loss. Also, who else is selling down here? There are new shorts. They're selling to open a new short position. They're the wrong way traders. They don't understand the ebb and flow of the markets. They're entering to anticipate a drop in price when in actuality, they're becoming fuel for the continuation of our trend. So we don't sell the lows. We don't buy the highs. And again, the profit target or where the market will turn can only be known in hindsight. So now we have the base about what we or how these market structures are created or look in our markets, and who and how they create these trends inside of our market. Let's move on to the flow of how these measured moves exist inside of our markets. And it's very important here to note that we have the basic move, we have the extension, we have the expanded extension. And it's also important to note that you can start out from any moment, any part of this flow chart. And as long as you know where you are in the chart and price, you can set your expectations and know what your next opportunity will be. The series of measured moves is the market trend, starting at the market structure low and ending it at a market structure high for an uptrend, and vice versa from a high to low for a downtrend. It is important to identify the series of moves that is currently in play. Isolated moves by themselves do develop in markets, but they don't have any predictive power. Once the latest move in a series is broken, the potential trend reset is at the full halfway back of the complete series. And we're going to go over this here. The price moves in waves. It advances, it retreats. It advances, it retreats. So let's start here, and we're just going to start. We can start from anywhere on this flow chart. We can start from anywhere. But we're going to start at where we would anticipate there would be a new trend. And most new trends start at the end of an old one. Like a short breaks and then a new pullback develops. So we started a trend change in this particular example. And the first thing that we do is we draw a basic measured move, a traditional measured move. We wait for our entry at halfway back long. And then one of two things happen. Tick by tick, we're waiting for participation. We're waiting to look for a reaction at that halfway back. And one of two things happen. A profit target is hit or there's a trend break. So in this particular situation, what happens? If a profit target is hit, we exit the profit at the profit target. What happens if there's a trend break? The trend break takes us to a stop loss and a trend change. And then we draw the opposing measured move and there's a new reverse direction. And that starts a new trend. So this is where the 61.8% line failure comes in. When we talk about our three types of setups in our other webinars. What happens if the traditional measured move hits a profit target? We hit a profit target, yes. We take profit at that target. One of two situations happen at that target. We either stop at the target, no, we don't go through it, or we go beyond the profit target, yes. This is what turns markets from traditionals into extensions. Now we can stop at the profit target, and what happens after that? If it doesn't go through the profit target, we draw the next basic or traditional measured move. And then this happens all over again. This is a traditional measured move over and over and over and over. We've seen traditionals 6 times, 7, 13 times, 20 times in a row. At some point, though, there's a moment where the market either breaks its trend or goes into extensions. It goes beyond its profit target. If it goes beyond its profit target, then we draw the extension. And we're now in extended moves or expanded extended moves. We wait for the entry. It's important to first understand that in any first extension, and this is the one thing that we have to watch out for extensions, whenever we have a brand new anchor, we first observe the first reaction to the very first extension from that anchor, because we don't know for certain if there's an algorithm attached to it. If we can see the reaction, tick by tick, one of two things happen. If we hit a profit target, we move on to the next extension. If, say, it breaks its trend, and the trend breaks, yes, we go right back up to the stop loss. The stop is hit. There's a trend change. We can go from a traditional to extension to an extension break to a trend change, and then the market's reverse direction. What happens if we complete our profit target? We hit the profit target. Again, how does an extension develop? A new extension develop. We hit our profit target and stop on it. If we stop on it, we use the same anchor to new high. And we keep using that same anchor to new high over and over and over until one of two things happen. Either the trend changes or we go beyond the profit target. In the case of the going beyond the profit target, the previous high of the extended measured move, we wait for the entry. We look for the reaction. Again, one of two things happen. Either breaks trend or continues. The profit target is the exit. And as we move along here, after you get into extensions and the market is starting to run inside of them, most of the time, when extensions haven't failed and we've gone from extensions to expanded extensions, you'll observe a parabolic move. And then the trend will usually change after that parabolic move. So this is a way of, again, understanding what we do in and out every single day, but in kind of a more visual kind of plan in knowing where you are inside of that trend. And now we're going to kind of get into a moment here where we talk about what does a typical series of longs and what does a typical series of shorts look like. So it's important to understand some terminology here. BTO, buy to open, is a long entry. STC, sell to close, that's a long exit, right? STO is a sell to open, that's a new short. BTC is a buy to close, it's a short exit or profit taking. So this is another way to visualize that flow chart. We have a basic move, which is the buy to open, which completes its profit target, which is a sell to close. And then the pullback, which is a buy to the open, and then a sell to close. And then we start into extensions. We observe the first extension to make sure that there's participation behind it. As long as we have seen extensions starting to defend, we use the previous highs of our last setup to highs, and we have a buy to open. It's a long position. And then a sell to close at a profit target. At some point, extensions will fail. Here you see a break in the series of measured moves inside of the extensions. And inside of that trend break, like we had seen up here, we return all the way back up to the reverse direction and start at the new trend change. The trend change starts with that very first measured move short after the trend break. And it's a sell to open. And the target is a buy to close, the short exit. And then if we're inside of a series of larger setups, you can actually see where the market inside of that little series of nested measured moves could be falling back down into an even larger time frame support level. And then we fall into another all the way halfway back long setup inside of a larger series. So again, that's another way to visualize what's going on inside of these markets, inside of those longer term trends. Next, we're looking here at a typical series of short setups or the progression of measured moves shorts. It's exactly opposite. It's important to understand the terminology here. The sell to open is a basic traditional measured move, a basic or what we call a traditional measured move. There's a sell to open and then a buy to close, which is the profit target. And then the next basic move, a sell to open and then a buy to close. You see, we go through the target here. We start an extension. We observe the first one. We can see its participation. We can use the extension as a sell to open and a profit target hit. And then we see a break in a series of measured moves. That's what starts the change in trend. We go, and that's what, when we're talking about, we go from traditionals to extensions to straight down or straight up. And then we have a trend break and then a trend change. That's exactly what we're talking about here. And then there is a reversal. There's a basic move, a buy to open, and then a sell to close, and there's a new trend change. And it has the potential of coming all the way halfway back short if we're inside of a larger trend. So these are two examples of another way to view that flow chart. The flow chart and these series are essentially the same things, just viewed in a little bit different way, so you can kind of visualize what you're looking for in price in the moment, or when we're looking for those levels of participation. Let's go to our next slide here. This is what's called a market analysis flow chart. And it helps us understand where we are inside of that first flow chart. Every single day we start out on our long-term time frames and we drill down to the smaller time frames. This was what we're trying to understand or pick out is what the larger, most powerful trends inside of our markets are. So we can be on the path of least resistance, so we don't have to trade against the flow of the markets. In market analysis, it's best to start with the daily chart. Identifying the last completed measured move pattern is preferable to identify a series of moves that shows a market trend. Once you've found this series and move into the 15-minute chart to find the next measured move setup, we use the trend test and profit target of the last completed move. The trend test and the profit target will be different types of moves in different markets. So we always refer to our diagrams and our flow chart to find out where we are. The next entry is the new trend test, the 50% retracement identified on the 15-minute chart. It is possible to zoom in on the smaller time frame chart to fine-tune entries when we get down to the smaller time frame, but it's important that we base our entries on 15-minute charts. And you guys have probably heard that before. It's very dangerous to go just to micro time frames for the sake of trading micro time frames. The reason is that we can get caught up inside of those extremely small time frames and miss the longer term trend. And the smaller the time frame, the less market participants are going to be participating on it. They're going to be participating inside of those halfway backs. So there's nothing wrong with going to smaller time frames. It's just incredibly important that we don't stick and stay on those time frames and have our nose so close to the tree that we miss the forest. Here's a flow chart here for market analysis, and you can choose this with any market. You start and you choose a market. You start on the daily or weekly charts. And the next thing that you do on those daily charts is you look for a pattern in the last price swings. Do you see a pattern in the market? Do you see measured move, longs or shorts inside of that market? If you can identify a measured move on that longer term time frame, you can move on. It's a tradable market. If you can't identify on those longer term daily and weekly charts a series of measured moves in any way, then there's no consistency there. It's not a tradable market, at least not by these standards. It's not, there's not volume in it. There's not heavy levels of participation by algorithms that are taking advantage of these natural ebbs and flows inside of our markets. Most markets are technical. It's very rare that there aren't, actually. But once you've identified that daily measured move, you identify a series of measured move entries. If there is not a series of smaller setups as you go down into the hour and 15-minute charts, it's not a tradable market. Unfortunately, some markets are very technical on daily charts, but as soon as you drop down to, say, a 15-minute trend, there are no measured moves inside of it. If you can't identify a trend inside of that smaller time frame, it would be better to move on to a market that is technical. So what if you can identify a series of measured moves? If you can, you identify the active measured move in our series. That determines our current market bias. It could be anywhere inside of this basic flow diagram that we could be at that moment. We could be in an extension that is completed, gone beyond its target, and waiting for a pullback and looking for an entry. We could be in an extended, expanded move. We could be back at a traditional. What our job is to find out where we are inside of that trend at that exact moment, so we can identify the next active setup in that series. So once we identify that next active setup, that next active measured move in our series, we identify the phase of that active measured move, where it is inside of that pullback. And we also have to pay attention if there are any larger opposing measured moves that are moving against it. If we can, we use the 15-minute chart and we go down to that smaller time frame. So this is more of a way here to kind of understand why we go from the long time frames down into the smaller time frames. And once we can identify the active series of measured moves and it's moving in the same direction as our longer term time frame, we can continue to use that flow chart to identify where we are inside of that active chart and where the next opportunity could present itself moving forward. Let's move here onto our moving from the known to the unknown. This is an important concept to understand. And when we're talking about knowns and unknowns, what we're talking about here is what has already happened. This is being. It has already happened. We can see a series of measured move longs. Knowing what has happened in the past here and where we're going from the known to the unknown is an important distinction to make. You know, what we're doing inside of a market is we're going from what we can see is a pattern of measured moves and taking it into the present, and based on these patterns, trying to make projections about what the new opportunities could be. Okay? So what is the next unknown to become known? What is the next known to become known? So in this particular example, we're in a series of traditional or basic measured moves, right? And we're going from what is being, what is right now, to what is becoming or is going into the future. The two types of situations here are: one, a new basic measured move that continues the trend, or two, a trend failure, which will start a new trend. If there are two open opposing setups and the next unknown to become known is which setup is activated or trades first. And this is what we talk about with, we go with whatever trades first. Once a setup is activated, or once a setup has become known, as in we can see the participation, the market stopping at its setup. The next unknown to become known is whether the target will become hit or if it will break its setup. Right? So that is the next thing that's going to happen. How far will the group in control of the market let it retrace before stepping in to turn price back in to their favor, or will they cede control having achieved their goal? At what point is there a shift in control of price to the opposing group? You can't act until a new significant known is revealed. You have to wait for the actionable knowledge. You'll hear many times we're referring to no man's land. We're in that moment between where we've completed a profit target and when we're pulling back into the next unknown, next measured move. We don't know until we get to that new setup whether there's going to be participation behind it or if it's going to fail that trend. That is the new unknown. When price is trending or moving in a continuous direction, the next unknown is how far will the move go. It's impossible to know where it will stop if and when price moves to a target or breaks through them. We always wait for the market to tell you the trend has changed. Each halfway back is a decision, a test of the current trend in play. Every single one, every single pullback that the market has is a decision point, the potential continuation or failure of that trend. And again, it's very important that we understand the difference between what we know and where we don't, and what we can anticipate the next opportunity being. This is another way to look at this in kind of another chart where, or a table. We have the past. We have the knowns. We know the most recent highs or lows. We know the current swing that's in play. We know the last completed move or part of the series. We know what the results were of the last balance of force. The present, or the opportunity or threat, is watching the reaction in that next measured move or the next basic move or next extension move where we're running into the 50. We're watching the reaction tick by tick. We're using one of the 3 entry strategies to participate in that reaction. And then, of course, there is the future. There are the unknowns. And that's why we use the free trade and reduced risk trading strategy. The unknowns are if the next halfway back will be touched. 2, if there will be a reaction at the halfway back. And then if it does, if it doesn't, where price will go next. We know the known is if there's a reaction and it's defended. Where we don't know is where price will go next if it fails that series. The main pattern to try to identify is the series of measured moves, is the series of the market trend. So the series tells us who is in control of the market. The group whose opinion of the relation between price and value determines price action. Price follows value. The group in control does not want to lose control and will support a 50% retracement with new orders to reverse a change in price direction and momentum. Again, every halfway back is a battle line for control of the market's direction. This next slide here is it's kind of an example of nested measured moves, and I go into this a lot in my book and this is where the danger of the micro time frames are. We'll often hear that we trade 15-minute trends. We can go to smaller time frames, but there are smaller moves nested inside of the other, long and short. The smaller moves give validation to the larger moves by holding smaller retracements at halfway back or our TB lines. Be careful trading nested moves. They're unreliable and best viewed as tests inside of the larger move. If you trade an unconnected move, you can easily find yourself on the wrong side of the market with a smaller move fails. We wait for the obvious break of trend before reversing trading direction. We wait for a clear signal before entering a trade. If you can see here, and we're going to zoom in here on this, you can see here a normal basic measured move. Inside of that are what we would call micros, or waves inside of waves. And those are what is dangerous. They'll shake you out, they'll chop you up, they'll fake you out if you're viewing too close. So where a micro time frame could be seen right overlaid on top of it, if you put them right on one another, you would have all this noise, but very technical 15-minute trends that take you from the basic measured move or the traditional into the target. And there are all these little waves, the micros inside of them, that can actually be detrimental to you. Again, this is a series of basic measured moves, a basic measured move long, what turns into an extension, a new extension. You can see all the fractals inside of it, defending, running into targets, and then it broke its 61.8% line. This is a trend change. Price naturally forms around 50% retracements, and will try to hit the trigger points to get the programs to activate and move price along its journey. The confluence of a profit target and an opposing halfway back start can confirm a level and add to the participation of a move. So this is an example again of how those micros can help you and hurt you inside of those longer term 15-minute trends. This is an alternate view of price action. And while we might not necessarily have any 50% retracements here, what you can see is what the ebb and flow or what happens inside of those price patterns. In an uptrend, sell levels fail their second test. And what that means is that at the top of this move, there was somebody that was selling. Either they were taking profit or they were initiating a new short. The rally in an uptrend, the buy levels or the runs through our previous highs are the squeezes of those previous sells in an uptrend. Extensions and trend breaks could represent a burst of stop loss or market orders in a place where momentum players join in, or a short squeeze or a long liquidation. At a certain point, the dominant side becomes out of balance with more weak hands that join the move in its later stages where early entrants, strong hands, have exited with a profit target. So you can see here as all of our previous highs break out, there's a market order. Boom. We break out of a previous high, there's the market order. Normally this is where your profit target would be. You can see here the accumulation of longs. We go from buyers as a balance of power to sellers, and there's a market order breaking through a previous low, and vice versa. So it's important to note that when we're going through a previous high into a target, a profit target is created by the market orders of the previous swing high, or vice versa when we're inside of a series of measured move shorts. We're going to drill down a little bit further here into what happens inside of a basic move, what happens inside of an extension. The model predicts that the price will continue an uptrend until or after a reaction of a halfway back short. Traders place orders at the halfway back to stop the selling from the last profit target, from the selling of the last profit target, and support price at the halfway back buying level. Now, this is what we call the balance of forces in a basic measured move. Now, inside of a halfway back long, there is a balance of forces. Why the market stops is because there are shorts with profit, there are longs with a loss, there are shorts with a loss, and longs with a profit. Why these 50% retracements can be manipulated is because of that balance of force. There's always someone on the other side of the contract in the derivatives market. It's a zero-sum game. There's one winner, there's one loser. The vast majority of contracts are never exercised, but are closed before expiring. The contract's purpose is to protect a position for the hedgers and to give opportunity for speculators. It's also important here to understand of course, we have the profit target up here. We have the most recent high. We have the most recent low. We have the trend test and then the trend break. But it's also important here to, and this is just another way of looking at the same thing that we had just looked at, is looking at where and what creates these pullbacks. The pullback is created because of longs with profit. Again, it rallies and it hits its profit target. with longs with a loss, getting stopped out. In the pullback here, the longs with a loss are selling. Inside of a pullback here, we have new positions inside of longs, creating another run to a target, which this is the point of imbalance. This is the point of balance between the four internal forces. And when we hit a profit target, or the reason the market rips to its target, is because of the point of imbalance between the four internal forces. At the target, we just have the sellers or shorts with a loss and the longs with profit. And then it starts all over again. And then there's profit taking again, and it starts all over. In the next pullback, taking profit, there's shorts with a loss, they're buying them back over and over and over again. This is a similar way to look at it in an example of an extension. We have on the way up through the profit target, the market imbalance. Inside of the pullback is a market balance. That's why it's easy to manipulate into the continuation of the trend. We have, again, sellers with a profit, longs with a loss, sellers with a loss, and longs with a profit. The extended move past the profit target, the model predicts that the price will resume its uptrend after the reaction to the same side halfway back, or the extension. Traders place order at the halfway back to stop the selling from the profit target and to support price at that halfway back buying level. A short squeeze, longs press their advantage. Longs take profit and price drifts down only to the point of TT, and then buying comes in to keep, or the trend test, excuse me, TT is the trend test. Then buying comes in to keep shorts trapped below that new trough. Price moves quickest when taking out market orders, stop losses of the wrong way traders. Again, the market moves quickly in a pullback because of the buyers at highs. It moves quickly away from its support levels because of the sellers inside of those lows. The market moves really on the pain, yes, on the wrong way traders. Let's talk about hedgers versus speculators and the difference between the two. We're mostly speculators, but futures contracts were built for hedgers. Hedgers and speculators work at cross purposes. Hedgers short futures in expectations of prices falling, hoping that they gain of covering the futures will match the loss in the primary asset. Hedgers do not profit from the drop in price, but protect the profit that they've made so far. Speculators go long or short futures in the expectation of price rising or falling, hoping to profit from the drop or rise in price. So hedgers protect. They protect their shorts or they protect their positions from price drops. Hedgers, when they sell or short, they're protecting their long position from a price drop. They short the futures market to protect a long position from a price drop. They go long to protect a short position from a price drop. And then they get completely 100% flat. It's just an insurance policy. So what are we? For the most part, we're speculators. We profit from the price when the profits rise, or we profit from a price rise. And if we're sellers, we profit from a price drop. So it's incredibly important to understand the difference between the two. And the reason it's important is many times, especially on the indices, we'll see our markets just going straight sideways in a range, like in the summer, like we've seen at highs on the ES. Most of those positions, most of that price action is created by protectors or hedgers, not by speculators. They are putting on position a protection and taking it off. They're protecting a long position by selling futures. And then the price rises when they take it off. And it lowers when they put them on, and it rises when they take it off. Over and over and over again, and we go straight sideways. Over and over and over and over. Completely sideways. And that's all most of the volume in the summer is. The protection going on and off and on and off and on and off. This is another diagram that Random made, and I absolutely love this image because it puts another kind of spin on the progression of measured moves and how it changes from longs to shorts and from shorts to longs. These are the phases of a measured move that we were talking about that had the traditionals or the basic ebbs and flows inside of our markets. But where a pullback begins, a long entry starts, right? That's the first phase in the trade between the entry and a stop loss, right? There's a potential reversal zone. One of two things happen. It either, again, moves up into its previous high and takes out its high, hits its profit target, or it fails its 61.8% line. And then the sellers outnumber the buyers. And the supply and demand shifts from buyers to sellers. And then what happens? It takes out its previous low. The profit target is hit. And now we're inside of a new 50% short. The market retraces up into a new short entry. And then we continue the series of traditional or extension shorts until the trend changes. And at some point, inevitably, there's going to be a short break. And then the market changes from the demand or the buyers outnumber the sellers. And the markets take out their most recent high. A profit target is hit. We take out a most recent high and pull back into the next entry. And then the longs continue over and over and over again until they fail. Here's another way to look at that, and we're adding in another kind of layer on top of this to combine the phases of a measured move with our previous examples of a traditional and the phases of these pullbacks, or in the case of shorts, rallies into resistance. We start out in a long entry. There's the potential measured move long at the 50% retracement. It's a halfway back long entry. This first phase, one of two things happens. We either bounce off the 50, we know our risk-reward ratio, or it fails the 61.8% line. If it fails the 61.8% line, we go straight into shorts. If it bounces off its 50% retracement, it goes into phase two, running up into its most recent high. It takes out its most recent high on the way to its profit target. And then, of course, we start another phase four where there's a pullback. And then there's a new entry. And it starts over again. Now, say that we had failed. The markets had broken through that 61.8% line. The markets sell off. They break their most recent low. The most recent low. They take out the low. They hit a profit target or reverse in this case and turn into a brand new short position. The new short setup trades. We're in that phase one again. It either works or it doesn't, and it continues until it fails. Over and over and over again. Now, this was a little bit longer than I wanted to do here, but this is a foundation that I'm so thankful for Random helping me with these, because it's not always evident when you're looking at price, right? When you're coming off of moving average and Bollinger Bands and even line charts or bar charts. Once you have the kind of pattern in your mind, you will see these markets in a completely different way. And my hope is that this helps clarify, not only for those that have already seen these patterns in the market, but also people that are brand new to this way of looking at the market.